All right, let's dive right into this explainer. Today, we are taking a pre-revenue, clinical stage AI tech bio company and subjecting it to the absolute most rigorous traditional financial frameworks in existence. Basically, we want to see exactly what happens when cutting-edge AI drug discovery collides with the old-school, strictly mathematical valuation rules of the greatest investors in history. Here's our game plan for today. We'll start with a company snapshot, apply the Buffett and Graham lenses, look through the Peter Lynch lens, build out a DCF valuation model, check out some alternative valuation models, and finally bring it all together for our synthesis and final recommendation. Let's get to it. Starting with Section 1, our company snapshot, decoding AI-driven drug discovery. First up, we need to establish exactly what Recursion Pharmaceuticals is and where its financials currently stand, just so we have a solid baseline for our models. So Recursion is a clinical stage tech bio company, and their stated mission is to completely industrialize drug discovery. How? Well, they use an AI-native operating system that's powered by their BioHive supercomputer and over 50 petabytes of proprietary data. They've built up this massive clinical pipeline, including REC-4881 for familial adenomatous polyposis, or FAP for short, and REC-1245 for solid tumors. They are quite literally trying to map biology to design drugs faster and cheaper. But here's the kicker. Today, despite all that incredibly futuristic technology, the stock price sits at just $3.18. That is way down from its IPO highs of just a few years ago, which obviously begs the question for us as analysts, is this just a classic value trap, or are we looking at a massive, highly misunderstood opportunity? Moving to Section 2, the Buffett and Graham lenses. Honestly, this is the value purist's nightmare. Let's apply the incredibly strict, conservative lenses of Warren Buffett and his mentor, Benjamin Graham, to this futuristic company. As you probably know, both of these guys demand absolute stability. Buffett looks for that deep economic mode, highly consistent earnings, and a strong return on equity. Graham? He wants to see earnings stability over a decade, a reliable dividend record, and moderate price-to-earnings ratios. You can probably see where this is going, right? This immediately sets up a massive clash with a cash-burning biotech. If we try to calculate Buffett's favored owner earnings here, we're just looking at deeply negative numbers. So what actually happens if we plug Recursion's real-world numbers, specifically its projected 2025 earnings per share of negative $1.44 and its negative ROE, into Benjamin Graham's famous intrinsic value formula? Any guesses? Yeah, we get zero. The crucial point here is that it mathematically fails. See, Graham's formula requires taking the square root of 22.5 times EPS times book value per share. Because Recursion's EPS is negative, the square root formula literally just breaks. Meaning, if you are an absolute value purist, this stock is mathematically untouchable. And this table really illustrates that perfectly. While Recursion totally passes the adequate size check with a $1.72 billion market cap, and they pass the strong financial condition check, they have a healthy $665 million cash runway that extends into 2028. It completely fails the earnings, dividend, and PE requirements of Graham's defensive checklist. Under these strict frameworks, your margin of safety here is zero. You just walk away. Let's jump to Section 3, the Peter Lynch lens. This is all about finding the growth narrative. So shifting gears to look through the eyes of Peter Lynch. Now, Lynch is much more forgiving of early-stage, high-growth companies, as long as they have a strong balance sheet and the right operational catalyst. And Lynch absolutely loves an inflection point. As Recursion's CEO stated here, the company is moving from theoretical AI models to actual, tangible clinical proof. We're actually seeing this right now with REC-4881, which recently showed a 43% median reduction in polyp burden for patients after 12 weeks. For Lynch, that is exactly the kind of narrative shift you want to see. So how would Lynch categorize them? Well, the PEG ratio is undefined because of those negative current earnings, so he wouldn't use standard growth metrics. Instead, Lynch would likely classify this as an asset play wrapped in a highly speculative fast grower. He'd be looking at that tangible $665 million in cash, the 50 petabytes of proprietary data, and, maybe most importantly, the $20 billion in potential future milestones locked within their Roche and Sanofi partnerships. Through the Lynch lens, this becomes a speculative buy if you believe those assets will eventually monetize. Okay, Section 4, our DCF valuation model. Let's start quantifying some of these assumptions. Let's move away from philosophy and actually build out a discounted cash flow, or DCF model. Fair warning, this requires some pretty aggressive, forward-looking assumptions, simply because current free cash flow is severely negative. They're burning through about $390 million a year. To make this model work, we have to assume that operational cash burn eventually flips positive, which we model by assuming Recursion successfully unlocks those massive pharma partnerships over the next few years. For our terminal value, we use a standard conservative perpetual growth rate of 2 to 3%. But crucially, we have to discount all of this at a very high weighted average cost of capital, around 12%, just to account for the extreme clinical risks baked into biotech. So, according to financial models projecting out to 2028, which is the year the company expects to start generating significant revenue, estimated at around $220.9 million, this base case DCF yields a fair value of $7 per share. Think about that for a second. That represents a massive 122% upside from today's price. But let's take a look at the sensitivity table to see how this builds, because this is where the risk becomes glaringly obvious. Depending on your assumed cost of capital and terminal growth rate, that fair value swings wildly. Apply a highly punitive 14% discount rate and your fair value drops under $5. Be a bit more generous with a 10% rate and it shoots past $10. This really highlights the extreme volatility and execution risk we're dealing with here. Section 5. Alternative Valuation Models. Let's look at the comparables approach. Now let's step outside of our own internal models for a second. How does Recursion actually stack up against its direct AI tech bio peers in the open market? Using a comparable company analysis across AbCellera, Recursion, and Schrödinger, we see a really fascinating dynamic. Recursion commands the highest market cap of the group by far, at $1.72 billion, and it holds the highest price-to-sales ratio, trading at nearly 20 times sales compared to Schrödinger's 3.45. Clearly, the market is charging a massive premium for Recursion right now, but there's a specific reason for that. Recursion's estimated sales growth of 73% next year absolutely dwarfs the competition. If they actually hit those growth targets, that 19 times sales multiple is going to compress very, very quickly. Finally, Section 6, our synthesis and final recommendation, the Guru Consensus. It's time to bring all of these distinct frameworks together to reach an impartial investment synthesis. We've looked at the absolute purest value metrics, narrative growth analysis, quantitative cash flow projections, and market cons. Here's the master view. Traditional value investors like Buffett and Graham see a stock worth zero. Negative earnings just break their math. However, the growth lens of Peter Lynch and our own DCF model project massive upside, pointing toward that $7 valuation, assuming the company executes and unlocks those partnerships. And the comparables? Well, they show it's expensive today relative to peers, but that premium is justified by its future growth projections. The balance here is just incredibly stark. On the strength side, you've got an amazing cash runway of $665 million extending into 2028, over $500 million in partner payments already validated, and up to $20 billion in potential future milestones. Plus, Kathy Wood is bought in. But pitted directly against that is a massive $390 million annual burn rate, zero fundamental value under traditional metrics, and a total absolute dependency on their early clinical trials actually succeeding. So what kind of investor are you? Ultimately, your decision rests entirely on your personal investing philosophy. Value purists must avoid this stock until positive free cash flow is consistently achieved. Growth optimists might see anything under $3 as a really cheap entry point to accumulate a massive AI asset play. And for the quantitative analysts out there, the current price of $3.18 offers a deep, calculated discount to a $7 long-term target. Which leaves us with one final, vital question to ponder. Looking at all this data forces us to ask, in the race to completely industrialize medicine, is the promise of AI worth throwing out the traditional financial rulebook entirely? It's a question every single investor looking at tech bio has to answer for themselves. Thanks for joining me on this explainer, and keep questioning the data.